Hello and welcome. In this video, we will break down Coeur's downside protection price hedge to show how one can use producers' derivative positions to see where the largest producers think price will and will not go to help gauge price movements. In the third quarter report, Coeur states that, quote, the company's downside metal price protection program uses put spreads to protect 25 to 40% of expected future production against a sharp decrease in metal prices, while selling intra-quarter out-of-the-money call options when appropriate to offset the net cost of the put spreads, unquote. A put spread is two offsetting put options. In this case, one put option is purchased as an insurance policy locking in a sell price. The other put option is sold to pay for part of the cost of the insurance. Let's break that down further. Quote, all put options purchased have a strike price of $18 an ounce and $1,200 an ounce for silver and gold respectively, unquote. By buying these put options, Coeur has locked in the right to sell silver for $18 an ounce and gold for $1,200 an ounce. If the price of silver is below $18 or the price of gold is below $1,200, Coeur has locked in the right to sell some of the production of silver for $18 and some of the production of gold for $1,200. Used this way, the $18 silver and $1,200 gold put options act like an insurance policy. If the price of silver did not drop below $18, the $18 silver put options expire worthless and unused. If the price of gold did not drop below $1,200, the $1,200 gold put options expire worthless and unused. Quote, all put options sold have a strike price of $16 an ounce and $1,050 an ounce for silver and gold respectively, unquote. By selling these put options, Coeur has sold the right for someone else to sell to Coeur silver for $16 an ounce and gold for $1,050 an ounce. The money received from selling these options offsets part of the cost of buying the $18 silver puts and $1,200 gold puts. If the price of silver is below $16 or the price of gold is below $1,050, by selling the put options, Coeur is obligated to buy silver for $16 and gold for $1,050. When placing these spreads, Coeur felt that the price of silver could drop below $18 and gold could drop below $1,200, but they were not expecting silver to drop below $16 and they were not expecting gold to drop below $1,050. So one can think of it as Coeur bought insurance policies that lock in the selling price of part of their production to help pay for the insurance that they bought. At the same time, Coeur sold insurance policies that lock in the right for someone else to sell silver and gold to Coeur if the price of either drops below a certain price that was, when Coeur placed the spread, lower than Coeur thought the price would actually go. The money received from selling the $16 and $1,050 put options is not enough to cover the cost of buying the $18 and $1,200 put options. Therefore, to cover the remaining costs, Coeur also sold call options. When someone buys a call option, they are locking in the right to buy something at a preset buy price. By selling call options that are above the current prices of silver and gold, Coeur is selling their commitment to sell silver and gold at prices that are higher than current prices. Coeur is selling the obligation to sell silver and gold for prices that are higher than they think the price of either will actually climb to before the options expire. The money received from selling these call options pays the remaining cost of the put spreads. If the price of gold or silver were to shoot up before the options expire, Coeur is obligated to sell some of their gold or silver for a locked-in price. This means that Coeur would be forfeiting part of their profit. However, if the price of gold or silver does not shoot up before the options expire, the options that Coeur sold expire worthless, and Coeur keeps the money they received for selling the options. It is logical to assume that the largest metal producers have a better idea than most about where the price of the metals they produce will head to in the short term. Coeur spread trade shows how looking at the derivative positions of the largest producers can indicate where the largest producers think price will or will not move to within a certain period of time. Coeur spread trade shows that they were concerned that silver could drop below $18, but they did not think it would drop below $16 before the options expire. And they were concerned that gold could drop below $1,200, but they do not think that gold will drop below $1,050 before the options expire. Furthermore, the call options they sold indicate they are also not expecting the price of gold or silver to suddenly shoot up over the next couple of months. With the price of silver currently sub $16, one of the largest producers showing that they did not expect the price to drop this low may suggest that price could be near the bottom. So to summarize, Coeur bought put options that act like an insurance policy, locking in the right to sell some of the production for a preset price in case the actual price drops lower than that. To help pay for the insurance they bought, Coeur sold put options that act like an insurance policy for someone else, locking in the right for someone else to sell silver and gold to Coeur at prices that were lower than Coeur thought the actual price in silver and gold would go before the options expire. Their goal was that the price of silver and gold would not drop below $16 and $1,050 respectively, and the insurance they sold would simply expire worthless. To help pay for the insurance they bought, Coeur also sold call options that obligate Coeur to sell silver and gold at prices that are higher than Coeur thinks the actual price of silver and gold will go before the options expire. So that is Coeur's hedging for downside price protection explained. I hope that you enjoyed this video. Thanks for watching.